After everything going to in the stock market, with the Nasdaq falling the most in one day since February, companies having layoffs on a daily basis, and the housing market coming to a complete halt with the highest mortgage rate in recent history, the Federal Reserve finally decided to pause the rate hike once again for the month of November. But has the Federal Reserve gone too far? And is it already too late to stop a recession? How will this affect the overall economy, the stock market, the real estate market, and most importantly, how will this affect you? In this video, I'm gonna go over how the interest rate is affecting everything, including you, and share with you the best opportunity in the housing market to buy a particular type of home, so that even if a recession comes, you know you got the best deal on your home. If this is your first time here, my name is Zhang. I'm a homeowner and a real estate agent here in Austin, Texas. I talk about everything real estate and life in Austin. If you enjoy content like this, be sure to like the video and comment if you have any questions, and be sure to subscribe to the channel. I appreciate your help. We're now in one of the highest interest rate environment in more than a decade. But how does that affect you? The Fed fund rate, which is the interest rate, is currently sitting around 5.5%. This means the 2-year treasury is giving a 5.06% return, and a 10-year yield is giving a 4.67 return. So what does this mean? Why is this important? Well, a treasury yield is basically a debt issued by the US government that promised its debt holder a return plus the principal. Meaning the higher the interest rate, the more interest the debt holder will receive. And that becomes a very attractive option because the United States has never ever defaulted on its debt and obligations to its debt holder, not since 1971. In 1971, when the United States got rid of the gold standard, which basically means that you don't have to hold physical gold in your reserve to back up your currency, you can basically rely on the full faith and credit of the United States to back up its obligations and make sure the currency has purchasing power. Now, we should be concerned about this high interest rate environment because the higher the interest rate, the more the US government has to spend in order to pay back the debt holders. And guess who is paying for that debt? Actually, the taxpayers like you and me. The higher the interest rate, the more amount we're paying in interest payments, and the more tax money goes towards the debt holder instead of funding programs that might be beneficial to us all as a society. Now, for the past decade or so, the US has enjoyed a very low interest rate environment where they didn't have to pay much in terms of its debt obligations. And longer the interest rate stays high, the more debt that we issue, the more we need to repay in interest payments. So this could cause a long-lasting effect for the next decade, for the future generations, and that's why it's something to be concerned about. And since the interest rate or the risk-free rate is so high, it changes investors' appetite for risk. And I'll go over what that means for the stock market later in this video. So since the high interest rate is such a big issue, why can't the Federal Reserve just lower the rate and stop with this madness? Well, that's because of inflation. The reason the Federal Reserve lowered rate to near zero during 2020 and 2021 was because of the COVID crisis, where unemployment rates spiked to historical highs in the span of less than a month. To stimulate the economy, we had a federal monetary policy that lowers interest rate to zero, but at the same time, a fiscal policy by the US Congress that put money onto the main street via PPP loans, via stimulus checks, and via other programs to get money to the people. And this basically served as 2 shots of steroids into a limping economy that boosted up everything. People started borrowing money basically at zero interest rate. People start refinancing their homes. People start buying homes. People start buying assets. Everything gone through the roof, and that caused inflation. Once the Fed saw that the economy has gone a little bit overcorrected, they started hiking rates, started raising rates in March of 2022. And they continued hiking every single month until June of 2023, where they paused rate for the first time. But they raised the rate once again in July, but then paused again in September, and then paused again here in November. Has it been effective in combating inflation? Well, inflation has gone down to currently sitting at 4.8% per year. While inflation did drop from its peak to the current 4.8%, but that 4.8% is still a long way away from the 2% long-term inflation target that the Federal Reserve tried to maintain. So does this mean the Fed will keep on hiking rates? We don't know. But here is another issue that's of concern. and that is whenever Federal Reserve hikes interest rates, full effect is not seen in the downstream economy until 10 to 18 months later. So right now in November 2023, we're seeing the full effect from November of 2022. Back then, the rates were around 4%. Today, we're sitting at 5.5%. So in theory, we still have a year or so to see the full effect of the rest of the 1.5% if we decide to stop hiking rates today. So this brings us to our next question, which is how does the interest rate affect the housing market and how should homebuyers feel about buying a home in this high interest rate environment? Well, first let's dive into the numbers. The core inflation metrics, which is something the Federal Reserve uses to gauge its policy on how effective their monetary policies are, show that in the months of September, cost of shelter has gone up 0.6% compared to last month, which is one of the highest amongst all of the metrics. This means that despite record pace of hiking interest rate, the housing costs still remain high for a lot of people. But this is because of the low supply environment that we're sitting in. There are no homes coming to the market. But why is there such a low supply? Well, one key indicator we can look at is the unemployment rate, which is sitting at one of the lowest in recent history, which means that people have the ability to repay their mortgage, they don't have to sell their home, so there won't be any supplies coming to the market anytime soon. Especially with homeowners who are in the hot market, who saw the equity in their home raise 50 to 100% in the span of 2 years, and they had the opportunity to refinance their loan to around 3%. So they have low monthly payment and high amount of equity in their home, so they're not really in a rush to get rid of the home, even if something bad happens to them. So this could mean that we might not see as much of a home price dip as people might expect. So what does this mean for people sitting on the sideline waiting to get into the market? As I mentioned before, if a home seller has no desire to sell at very, very low price because they have a very low monthly mortgage payment and they have plenty of equity in the home, it's incredibly difficult to find an opportunity where home prices drop by more than 50%, and that's when you get into the market. Because we're not sitting in 2008. I know there are a lot of people out there praying that it's 2008 where we see home prices crash 40% in some areas, and there's just a bloodbath on the street. But the 2008 housing crisis is caused by subprime mortgage. People are lending mortgages to people who truly cannot afford it. And they were able to leverage those homes into buying more homes, causing more of a spike in the home prices and then more of a downturn in their downswing. But the lending standard has remained high, and it's just very unlikely to see home prices drop due to subprime mortgages. Right now, what we're witnessing in the housing market is falling in a very orderly fashion, just as the Federal Reserve designed. But you might ask, William, didn't you say there is an opportunity in the marketplace that people can get into their homes? Well, yes, there is an opportunity in the housing market right now, and that is to look into inventory homes by home builders. Opportunity arise in the market when there's unexpected events that happen. And in this case, the unexpected event is the Federal Reserve hiking interest rate at record pace, going up from 0% in early 2022 to more than 5.5% here in late 2023. And that basically caught the home builders by surprise. Here is a quick behind the scenes of how home builders work. They go out and borrow money from the banks at a high interest construction loan, and they use that money to build a house and to buy the land, to build a house, and eventually once they sell the home, they can repay the bank. And the banks, in order to protect their interest, they will set a date that you have to pay the money back by. If you don't pay back that money by that date, they will hike interest rate on the loan and the builders have to pay more. Now, because of the high mortgage rate we're looking at, home buyers are sitting on the sideline and people are just hesitant about buying a home. And the home builders are desperate. They're looking for ways to offload their inventory, and they'll throw incentives at you with rate buy downs, covering closing costs, free upgrades, builder credit, whatever it is, just so you can move into the home as soon as possible so they can pay back the banks, even at a loss. And for those of you who are still not convinced about buying a home in today's market, here is a quick chart of how much money is in the money market fund, which is what I call money sitting on the sideline. Since beginning of the rate hike, we've seen the money in the money market funds gone from $5 trillion to almost $6 trillion today. Now imagine when the rate starts dropping, instead of an 8% mortgage rate, we're looking at 6% or 5.5%. Where do you think those money will want to go to because they feel that this is going to be the normal interest rate for the foreseeable future? Those money is going to go into assets, things like stocks, things like companies, and things like homes. And as I mentioned before, due to the low supply environment that we're in, it's unlikely that the home prices will drop a lot more. Then imagine all the people who are waiting on the sideline wanting to get into the market. They start bidding on homes, then the home buying process become more competitive. You might have to overbid in order to get into a home at a lower interest rate. You'll basically have the same monthly payments that you see today. Now, I do want to say nobody has a crystal ball. Nobody knows exactly what will happen in the future, but this is a very reasonable scenario that could occur based on the data that I've been seeing. Before we dive into our next point, I do want to reiterate that I am a real estate agent here in Austin, Texas. If you're looking to buy, sell, or invest in Austin real estate market, be sure to reach out to me using the number in the description box. I would love to work with you and help you get your next home. Finally, how does the rate hike and the rate pause affect the overall economy and the stock market? Now, I do want to say the economy and the stock market are completely two different things. People often confuse that the stock market means the economy. It does not. Oftentimes, stocks are predictable and forward-looking. The economy usually lags behind the stock price movements. Now, let's imagine you're an investor. You have two investment options out there. One is guaranteed 5% for the next 2 years. Another one is a 5.69% return on your investment with some potential upside, but more potential downside as well. Which one would you choose? Well, this is exactly what's happening in the market today. Earnings and dividends return on SP 500 is currently sitting at 5.69%. Typically, when you invest in the stock market, you look for anything above 3% above the risk-free rate. So the risk-free rate sitting at 5% means that you want to look at investment or risky investment that give you at least 8% or 8.1% in return to justify the risk that you're taking. Since the equity risk return currently is sitting at 5.69%, which is only about 0.69% above the risk-free rate, it doesn't really make sense for investors to put a lot of their investments into the stock market. And in order for that investment to make sense, the stock prices will need to drop or their earnings and dividends needs to go up. And the only way the earnings and dividends will go up is that the companies will do well in the economy looking forward. And now let's look at how the job market is doing and translate that to the economy. Let's imagine again that you are a company owner. You're a CEO of a company and you own a technology company. And for the past 10 years or so, you were able to borrow money at near 0% interest rate. And basically you can use these monies to fund hiring, to fund projects that could fail, but that also potentially could give you a lot of return. So very risky projects. To invest in capital assets, things like buying a campus, building up a building, or buying a data center, and invest basically everything into the market because it's because the borrowing cost is so low. But now in the past year or so, you've seen that the borrowing cost to fund these projects, to fund hiring, to fund investments into different projects, to buy data center has gone up dramatically. The cost of borrowing has gone up multiple times. And now you start questioning, okay, does it really make sense to look at a project that could fail? So then as a logical business owner, you said, okay, let's stop hiring people and just keep the people that we have. And let's stop investing in such risky projects out there. Let's stop borrowing money at such a high borrowing cost. And let's stop buying data centers and investing in our infrastructures. It might not make sense right now since it's so expensive. Then after that, you keep on looking, okay, the market looks kind of bad. Maybe we need to start cutting costs. So the first thing you cut is your staff. So you start letting people go and you let your vendors know you're not going for any big projects for the foreseeable future. Then those vendors who also employ other people saw that, okay, my biggest customer, this technology company, no longer needs their data center, no longer needs all of the consulting practices that we provide. So I probably don't need that many employees to meet that demand. So they started letting people go. And that just causes a downward spiral that cascades to other market other than the technology sector. But now there are companies out there who were well funded, who refinanced at the right time, who issued debt that were at near 0% interest rate. For example, Apple, Microsoft, who had great CFO, who did the right things at the right time. They are well funded, they got strong cash flow, they got strong demand for their products, and they've been keeping everything in an orderly fashion. The most important word here is orderly. People can see, people know what the Federal Reserve is doing, and they can kind of expect what they do in terms of their rate decisions. And that's very important. And in an environment like this, purchasing a home means that you have to make the biggest bang for your buck and make sure that you don't make any costly mistakes. If you want to learn how to do that, be sure to check out this video.